Thank you all for jumping on amidst Wednesday for our econ internal seminar. Today, I'm going to be walking through an ongoing project I have been working on, investigating with other collaborators, investigating potential differential treatment of insurance claims within the National Flood Insurance Program. So I'll go into a little bit more detail about both aspects and the drivers, but generally the topic is investigating how income, race, and other kind of wealth indicators may be driving or may be related to how quickly or how fairly insurance claims are paid out. Okay. So a little bit of the context. We talk a lot about insurance as a tool for the economic resilience of households, also of kind of big institutions and cities. But a big question remains as to whether or not this type of market mechanism operates fairly for all households. And there has recently been a lot of reporting and investigative kind of studies from news outlets that indicate that there's potential bias within the insurance industry. And I'm sure if folks have dealt with negotiating with an insurance company themselves through health insurance or other insurance claims, you can quickly see kind of how the process can get frustrating, but also is a bit of a black box for individuals. And so part of what is driving some of this reporting and these claims that there's potential differential treatment is that insurance and insurance data is just a big black box. For most of our private insurance industry, there's no kind of mandatory reporting on any sort of outcomes at the policyholder level. And understanding the kind of like previous research around understanding this differential treatment has taken a lot of different approaches, including kind of real world experiments where they submit a bunch of different applications for insurance under different kind of names that indicate different race, and testing different different policy quotes across neighborhoods. So there've been a lot of different tactics to try and kind of elucidate whether or not there's pricing differential. But then at the same time, there's reporting that the actual like processing of claims, regardless of the pricing, has varied across race, but also insurers have like used that claim payment moment to essentially hold back dollars that any kind of policyholder would be legally would have the legal right to. So I'll just flag that this is a concern that comes up a lot when we talk to communities about insurance. Like there is a general sense of like, this is a private product and insurance companies are challenging to deal with. And how do we know that this is operating fairly and operating fairly for the communities that we're hoping to provide more economic resilience tools for? So the insurance landscape is quite large, and there's no way to get around the fact that private insurers are withholding of their proprietary data, but we do have a big source of insurance data that is public, which is the National Flood Insurance Program. So for folks who are unaware, the National Flood Insurance Program is a longstanding public insurance program for flood damage coverage, which is kind of excluded from most homeowners' policies. There is a small private flood insurance market, but the vast majority of flood damage coverage comes out of the national flood insurance in the US, dating back to the 60s and 70s. And with the national flood insurance comes a whole lot of kind of quirks and market impacts, which is includes the fact that many houses are mandated to purchase flood insurance if they fall within FEMA's defined flood zones. But that also there's kind of limits to the amount of coverage $250,000 per building, which obviously doesn't cover the full value of all homes. And also that pricing has historically been quite subsidized, but not subsidized on behalf of low-income households, just subsidized that kind of grandfathers in a lot of houses that are at high risk. As many of you know, that it's been a long legal and policy process to try and true up the National Flood Insurance Program so that it actually is aligned with risk. But this investigation doesn't dig into pricing necessarily. It is focused on a research gap that hasn't quite been covered in certainly the flood insurance literature, which is how claims are actually processed once they're kind of submitted. So there's a bunch of research around flood insurance demand and what drives flood insurance claims. And then there's a whole body of work outside of the kind of insurance and econ literature in like legal regulation around how insurance claims processes should get regulated, what the legal frameworks are within that, and then like legal case studies that show how it might not be operating like in the most fair process. But we haven't really had any big quantitative analysis of claims processing writ large. And we don't really know if that changes after big storms when you get a ton of claims, or differs across state regulatory environments, which is the level of regulation that we have in the US. So in order to tackle this, we have kind of two broad main research questions, and one is content-wise and content focused, and one is more methodological focused. So the first is just, does insurance claim payment, claims processing time, and the likelihood that a claim is closed without payment vary by income, race, and wealth? And then more methodologically, we're kind of interested in how this effect differs, but when you look at census geography effects, like neighborhood effects versus individual property effects. As you might imagine, getting individual level, both claims data, but also kind of household characteristic data is quite hard. So this analysis that I'll present is all at the census geography level. But I think there's some big open questions, bigger than just this study, of whether or not those types of associations are very strong, like the ecological fallacy of attributing census tract demography on the individual claims that are within it is not well, we don't know how strong that is. So we can make some kind of a national analysis at the census geography level, but we're going to try and use a sample of household level claims data. It is quite hard to get to try and validate that. So I kind of outlined our general research plan, approaching both claims that are closed without payment at all differently than claims that receive payment, and investigating a long history of flood insurance payments, ideally over the last 30 years nationally. So I'm working on this with Carolyn Kuski, and then also with Helena Garcia, who was an intern this summer with us on the econ team. She's going to continue working on this analysis and help us with this kind of validation aspect of the general data. Yep, and then we are pulling from public national flood insurance data, but also some data that is non-public around claims timing. And because of that, right now, the analysis I'll show you is just limited to 2/3 of the data. It goes up to 2012. And we are still waiting for a FOIA result for the last 8 years, which we are hopeful about. We think we can get it, but we have non-public data that helps us answer this for most of the time period, and we're working on filling in the rest. Okay, so one more thing before we dive into actual findings. I wanted to give a little picture of the insurance claim process and kind of what this analysis narrows in on. So the insurance claims process is ultimately just a big negotiation between the policyholder and the insurance company. And there's a lot of steps in that process, and there are a lot of actors in that process. Insurers have a lot of incentive to minimize the amount of payment that they might give, because any any payment reduction is essentially profit for the company, but there's obviously imperfect information, some imbalance in like power and access to decision making in this negotiation. And you can imagine in this kind of timeline of steps that there's a lot of processes where bias or unequal treatment might emerge. Like, could it be that households with lower income have lower kind of like understanding of the system and therefore ability to navigate it? They might not know the things that kind of the tricks or tips to either speed up the process or make it more effective, like documentation of certain damage, and certainly plenty of steps for individual bias to emerge, like assessor bias. So while it would be great to investigate every step of this chain, we don't really have data to do that. I've highlighted here in yellow where this analysis kind of touches on, which is we have data on where the adjuster, when the adjuster submits the damage estimate to the insurer, we have that damage estimate. And we also have the payment that the household ultimately received. So what happens in between those things? We don't have a true estimate of like damage outside of what the adjuster has determined. We also don't know the difference between that adjusted damage or assessed damage and what actually gets paid when they are different, in which they are different in most cases, why that's the case. So that's what we're trying to kind of tease out through this data. Okay, so I'm going to go through kind of the three indicators that I mentioned: claim payment, claim timing, and then the rates of claims being closed without any payment. And in all honesty, I'm going to go through a bunch of model output tables and just pull out the main findings. And then at the end, I'll just kind of give a summary of where we're at right now in terms of like the patterns we're seeing, and then next steps. And I have some questions for you all about kind of feedback for specific areas. So first, a tough question in this analysis is how to assess claim payment in a way that isn't directly associated with the value of the home, so that we can see differences in socioeconomic households, the socioeconomic factors of households. So to do that, we are looking at essentially like a ratio of the amount of payment received, claim payment received, relative to the amount of assessed damage, that payment over damage ratio. And what we see that just within the time period of data that we have is that has stayed like kind of relatively stable. So not a ton of like change dramatically in how much damage is being paid through the years. And then also just as like an average across this whole data set, that about kind of across the board, about 8 to 9% of claims kind of generally represent about 8 to 9% of like housing value. So on average, claims are not like full value of the home. It's like a smaller percentage. And then about 87% of that damage ultimately ends up getting paid. So when looking at the relationship between claim payment and income, we see a very small and very weak indication of income associated with claims payment. So median income is positively associated with income. And as the average tracked income increases, the relative payment increases, but it's quite a weak relationship. But maybe more interestingly, in the kind of full model where we've included a set of variables that also speak to the kind of building indicators, like building floodproofing, that there's several building indicators, elevation, floodproofing, kind of indicators of adaptation that actually result in lower relative payment. And this association holds kind of when you control for the possibility of coverage limiting payments. And it's quite curious and we don't really know. So this is like a little star for us to investigate further. But it is kind of concerning to imagine that a household would invest in elevation or floodproofing and then see ultimately the percentage of their claim being paid is less than their neighbors. So looking at other indicators of wealth, knowing that income is not always an indication of wealth, the results are kind of mixed. So generally we think about like home ownership and college education and property value as like a set of indicators of wealth, kind of additive to income. And we do see that higher education is positively associated with the relative payment ratio, but it's not kind of definitive across all three variables. And then looking at claim payment with race and the interaction effect with income, it's not particularly significant on its own, and the relationship between race and claims payment varies significantly across income brackets. So we have this kind of funny nonlinear relationship between, for instance, the percent of Black population in a census tract with and the income with the amount of claim payment, where it's positively associated with claims payment in the lowest income bracket, but quite negatively associated with, or negatively associated with claims payment in the middle income bracket, as you see in the kind of like base indicator here. So not a definitive story here at all, and maybe something to tease out a little bit further, and helps us maybe understand a little bit more that this is not like a linear relationship and it's not happening across the board necessarily, but maybe there's different effects happening in different neighborhoods depending on local context, or depending on local context. So looking at claims processing time, we can think about claims processing in kind of three different ways, three different timelines. We can think about it from the total timeline between the date of loss to the date of payment, what's the full trajectory, or look at that subset between when the claim has been submitted to when it was closed. And I think an important thing here to think about is like, how much do the systems, the ability to submit a claim, kind of influence the overall timing of whether or not a household gets payment. So just over time, very, very obviously, you can see that with years and incidences of like high catastrophe, big hurricanes, you see a much longer average claims processing time, kind of suggesting that the volume and the kind of severity of big events leads to just like a longer wait time. And then I think that bears out in much of the kind of practical understanding of how claims processing works, because you have a limited number of assessors on the ground working after a big disaster. However, this data, either in reality or because of some kind of idiosyncrasies of the flood insurance data, is quite long-tailed. There's the average median time to wait for a claim to be processed is about 50 days, but there are, claims that are recorded that took 2 years to process. And understanding kind of like the tail versus the median is kind of a next step for this analysis. Okay, so in terms of claim processing, surprisingly, compared to like what a lot of the reporting says, we see evidence that claim processing time is positively associated with income, meaning as the average tract income increases, there's actually longer average claim processing time, which is surprising just based on the qualitative reporting that has been put out thus far. And then in terms of wealth, the same indicators that we look at before, we also see a mixed story. Property value does not have a direct relationship at all to claims processing time, but homeownership and college education does, but in opposite directions, in ways that I don't think that we have a full understanding as to why. I think we might imagine, for instance, that if you have a higher population of college educated households, you might see greater negotiation or greater kind of appeals. But we don't know for sure, and teasing out some of those causal pathways is kind of like the core of the next step. And then again, looking at claims processing time and race and income interactions, a census tracts Black population is positively associated with claims time in the lowest income bracket, but otherwise negatively associated with claims processing time overall. Again, I think we see kind of like a mixed picture here where it's nonlinear and we don't have like a definitive result that kind of confirms what the reporting has suggested. So the final kind of indicator of fair treatment or kind of question within the claims processing is whether or not what happens with these claims that are just closed without payment. And I'll give a little background as to why this has been an important question for advocates or for folks who are working on recovery on the ground. So generally, the data around why claims get closed without payment is pretty weak. This is just like a summary of what the National Flood Insurance indicates are the reasons, and a lot of it is basically undetermined. It's like an other or no reason, or that the damage is attributed to something other than flood. But a lot of folks on the ground report anecdotally that assessors will come into a home and basically, if a home is maybe is not in as high of quality building, they will attribute kind of any damage from the storm as like previous damage and basically assume away a lot of the flood damage and therefore basically like decline all of the claim. So we don't really, all of that has been kind of anecdotally shared and it's a like narrative that people see on the ground, but we don't have great indications of that happening. And so we were hoping through this analysis, we might be able to show that these rates of claims without payment, like tracks with income or tracks with other wealth indicators. So what we see is that income is actually negatively associated with the likelihood of claims being closed without payment, suggesting that these tracks, it's very weak, of course, of a relationship, but suggesting these tracks in lower income brackets are actually less likely to see claims closed without payment. And in the upper income brackets, not much of a relationship at all. So that's definitely like counter to the common narrative. But just as like a confirmation that claims that are reopened are very strongly negatively associated with the likelihood of being closed without payment, meaning that that kind of reopening or appeals process ultimately results in probably like payment happening. Kind of counterintuitively to what we find with the income level, higher property value is very strongly negatively associated with the likelihood of claim being closed without payment. And I think I'll talk about this in the kind of summary slides, but this I think points to, and kind of all of our comparison between income and wealth and the difference between property value and income effects, I think points to one of the reasons why we are interested in testing the census geography versus individual property effects, because our property value data is at the claim level, it's at the property level, while our income data is at the census tract level. And when we see different effects between those two, I think it suggests that we are obfuscating some of the heterogeneity of income and class by looking at the census tract level. But regardless, we see this higher property value is negatively associated. And then we're really not seeing a relationship between race and claims closed without payment across the board. So that was a lot of mixed results. And ultimately, I think that's where we are right now. We kind of came into this thinking, let's see where this narrative about claims processing actually, whether or not that shows up in the data at all. And I think what we're seeing is like kind of mixed results, but no definitive or resounding pattern that, especially race, which is a lot of the public narrative around insurance inequity. Race at the neighborhood level has not been like a really driving explanatory variable for claims processing differences. And then also there's some indication that tract level and property level effects will differ. So I think right now where we can say, kind of looking at the national data, is that claim payment relative to damage is very weakly positively associated with income and education more strongly, and it varies non-linearly with race and income. And claims payment timing is also positively associated with income and education, meaning that with tracts with higher income and education are likely seeing claims payment taking longer. Intuitively, reopened claims are taking longer. That's what we would expect, and we're glad to see that. And reopening claims is strongly associated with a lower likelihood of the claim being closed without payment, meaning that if the claim is reopened, it's more likely to have received a payment, but it's not associated with a higher payment ratio, i.e., within the claims that are paid, the ones that were reopened are not significantly kind of higher payment. And then counterintuitively, the likelihood of claims being closed without payment is not strongly associated with income. That's what we just talked about. And then, but high property value is, which suggests that kind of dissonance between census and individual property data. So our next steps for this analysis, we are waiting on updated timing data. We've limited this analysis thus far just to 2012. And then once we get this like updated data, we can do the full 30-year period. And then we are, of course, really interested in trying to figure out whether or not this census geography analysis makes sense, whether or not it bears out when comparing it to property level data. So it's very hard to get property level claims data, but our partner Helena Garcia has a sample of this for North Carolina, and we are hoping to use a few property level indicators from HMDA data to basically test whether or not race and property value and income track within North Carolina the relationship between census geography and property. And I think we need to dig in a little bit more into investigating this negative relationship between elevation and floodproofing and the payment ratio. And that could be a programmatic nuance, or it could be something happening within the assessment that warrants more attention from a policy side. And then I'll just mention that this whole research project is funded and under this umbrella of this MOC project, which I've talked about several times. It's a collaborative research, community-informed research project in the Mid-Atlantic, intended to build interdisciplinary projects across fields. So what we're hoping is that we can provide some quantitative analysis, and partners who are coming out of the kind of qualitative social science field can help us fill in the gaps and fill in the causal mechanisms that we might not be seeing here with some qualitative surveys and interviews with households in Pennsylvania, New Jersey, New York. So I think that's it. That's about 30 minutes. I have some questions in general for folks about if you have feedback about other approaches to teasing out drivers of these patterns, or other methods of thinking about differential impact, as well as like other resources we should be thinking about in terms of like data to bring in, but happy to field questions or just chat.
If folks want to raise their hand, I can call on you.
I have a question, Jesse, but I can't find my hand raising.
Go for it, Carolyn.
Actually, this is maybe not really a question for you, Karina, but sort of for the team. And it builds on something that I saw Susie just put in chat. And I haven't thought much about, but maybe some of you all, or Karina, maybe you have thought about, which is when you find something, when you find a null answer, like maybe there isn't a strong relationship, or maybe there's no relationship with race, or there's not a strong relationship. I'm not saying, I'm not trying to reflect your actual findings, but like, how do we rule out, or how do we determine when it's actually a not true? Do you know what I mean? So Susie was saying, like, is it that there's power problems, or like you were talking about the data aggregation, like we just can't get this if we only have aggregated data, or maybe we just haven't been able to get to the underlying causal mechanism. But it seems, especially with equity, it's equally important to be able to say where there's not equity problems as it is to say where there are problems. But it seems like that's harder for economists in general to do that. And I guess I'm curious if you or anyone has thoughts on that issue in particular.
I'll say that just maybe to the last point, that it kind of keeps me up at night sometimes thinking about analysis that suggests that the experience of people on the ground is not borne out in kind of quantitative data. And I think I don't have an answer to that, but if other folks do, then I think that I would love to have that conversation. I think it's like framing, and also limit and being really honest about like what can and can't be seen through that.
I guess I'll just jump in. My first thought when you put up the regression results showing that higher income people are less likely to have bigger claims or bigger payments. My first thought was like people select into submitting a claim, so it might just be that like richer people are more likely to submit frivolous claims.
That's actually, sorry, Lauren, I didn't want to cut you off. Were you?
Yeah, no.
No, but I had a reaction to that because with your like auto insurance or something, right? There's like this question of like, should I submit a claim because then maybe they'll mark me and I'll end up with a higher premium because I'll seem high risk. And so like, is this really big enough to like merit doing it? Or at least theoretically people go through that process because auto insurers do start to mark you as higher risk when you submit more claims and do increase your premiums. The flood insurance program actually doesn't, unless maybe you hit the repetitive loss category. So I'm looking at Jesse and Karina to say that. But in general, I think that dynamic is less prevalent, but I'm not sure people know that, to your point. And so I wonder if there's sort of differentiation among segments of the population that are thinking about scheming insurance in a way that actually they don't need to be. I don't know if that's sort of what you're saying, Lauren. Maybe that wasn't related.
Oh, I mean, yeah, I think people that know that they have, I mean, it could just be that people with different like incomes and education levels select into submitting a claim differently, and that could be driving differences in payment to damage ratios that you see. You know, I don't know like what exactly a flood is, for instance. Like, is a flood any water damage, or is a flood, you know, like if I was a homeowner and my house had some like water damage because it was raining, I don't know, I might give it a shot, you know.
I think that's interesting. One thing we didn't do yet, and we could do, is disaggregate this by flood cause. They have like some indicator of like what kind of flood ish. And I think that's interesting. I think that, I guess maybe I'll just share what I think is like in the common literature around insurance, which is that generally lower income households are more likely to need payments that are marginally above the deductible relative to higher income households, if that makes sense. That like if I am on a budget and a big economic shock happens, or like my car gets totaled or my house gets flooded, I am more likely to need that coverage rather than a higher income household that might have more of a safety net. I'm not sure how that ultimately results in like the difference between payment to assessed damage. Like, I think I'm really curious as to why there's differences in that. But I do think I think your point about who is submitting claims is really good. And I don't know if we have data on like damage of households that are covered by NFIP but didn't submit claims, or kind of an estimate there, but that could be cool.
Lauren, you're muted if you're talking.
A really similar point is that, you know, to the idea that lower income households have a lot of claims just above the deductible, is that you said that there's a $250,000 maximum. Like, could it be that richer households are like have more damage than 250K, and that could also be driving it a little bit?
Yeah, I need to think through. I think that could, it's almost definite that there are households that have damage that are kind of beyond the coverage limit.
How does that show up in your data?
I did kind of 2 runs, which is I limited it to any claims that are below where the damage is below the coverage limit. And then another run where without that kind of filter or limitation. And one of the reasons is that there's a lot of claims data where the payment exceeds the coverage limit, and I don't know why. Like that, it doesn't make total sense. But to capture both, I kind of just checked to see if the effects were robust to both, and generally they are for all of the like main findings that I highlighted. But yeah, I think we could in a very valid way be like, we should only be limiting it to claims information that we have where we know the damage is less than the coverage limit, and thus any difference in payment is only related to some sort of insurance decision or assessment decision, payment decision. That makes sense.
I just thought of another possible explanation, and I don't know if this is in the data or something to look at, but I think that when you buy low levels of coverage relative to your home value, you automatically get actual cash value coverage instead of replacement cost, which means your damage to your cabinets could be 60K, but they give you the depreciated value of cabinets, which is only 30K. And then you get a payout that's much less than your damage, but it's through this mechanism that you had ACV instead of replacement cost. That's like really in the weeds on NFIP, but flagging that maybe we should look at that, and that maybe there's some like association between lower income households getting actual cash value coverage, which is much worse insurance coverage, but it's cheaper. And if you could show that they, are more likely to be in this category of the worst insurance, you could look at the savings that gives you versus the like huge penalty you get when you don't get enough to rebuild. Just brainstorming.
Mm-hmm. You know what that low level coverage limit is?
Forget. I think it's like a percentage of your home value. So like you have to insure to a percentage of your home value. Jesse, did you ever look at this?
I wasn't aware of that. I had a different
Are these
question.
only building or contents or both?
I've limited all of this analysis to just building coverage and insurance. So largely because contents coverage is, I just limited it to building for now, but probably another check to do.
Go ahead, Jesse, sorry.
Yeah, you might have already said this, but I was wondering if you think there's potential bias in the damage estimation step and data. Like, is that damage like actually indicative of replacement cost? Or like, could it be that these assessors are underestimating damage for some types of homeowners?
Oh, that's a good question.
Yeah, I think that that was that little like daisy chain timeline that I put out. So I've been thinking about this a lot because we don't have like an indicator of true damage. We only have what is documented by the assessor. And I think that you could imagine that there are like 3 actual values. It's what is the actual damage, what was documented by an assessor, and then what was paid by an insurance company. And those could be like 3 totally different things. And the processes between those are ripe for like bias or just, unintended consequences. I'm not sure if there's like an interesting way to think about true damage or some sort of estimate of true damage. It might be interesting. I know I like maybe IA payments or other kind of assessment, but I think likely the kind of human bias that occurs in insurance assessment or adjusting probably occurs in like IA, which is like FEMA aid damage adjustment too.
Yeah, I don't have any good ideas for how to deal with that. I guess like, can you also explain, like, assuming that the damage is below the coverage limit and you don't have this like ACV issue, why would there be like, what is like a justifiable reason for why there'd be like a gap between the claim payout and the damage?
It's a good question. Just like, why is the ratio not 1 for all?
Yeah, like how could like NFIP like justify that in some like reasonable way?
Yeah, I don't know. I mean, this is like, I'm kind of curious, maybe Carolyn, if you've heard something about this. I mostly like approach the data to be like, well, what's the average and like, where are there deviations and are those deviations associated with certain things? And I don't know why it would be like what happens between the step of assessment and payout. I do know that generally the line from NFIP is like, you will never get all of your damage paid, or it's never going to cover everything. And I don't know, that's kind of like a conceptual statement that kind of gets put into NFIP documentation, but how that happens in practice, I'm not totally sure.
I'd suggest that maybe prioritizing some of the qualitative interviews to kind of get more insight on the process before doing more of the data analysis might be helpful to get at some of those questions, because that's a really good question, Jesse. And the things that I can think of are like, would mean, and I've never heard that this is true, but I don't know how it could not be true and answer your question of like why they're not 100, is that the damage estimates actually is not one number. It must be many numbers, like basement, appliances, cabinet. It must be broken down. And we don't see that in the NFIP data, because then there's certain items that would be excluded. Like in the basement, they only cover large appliances. They don't cover like flooring, for example. So the damage estimate might have flooring in the basement, and then FEMA says that, and they're like, oh, we don't do flooring in the basement, line item that out. But that would mean there's like another level of data that they're not sharing that I've never heard anyone mention, but we should talk to someone in FEMA to figure that out. Because that's the only explanation I can come up with. You're right.
Wouldn't both deductibles and payment maximums make it so that ratio wouldn't be 1? Or I could be misunderstanding. But I would not expect that ratio to be 1 because of those two things.
But it should always be
It should always match the
minus deductible. Yeah, you should be able to
deductible.
match it out. But that's a good question. You could look at your
Yeah.
distribution of that. That's a good point, Lauren, and see, right? Like, because if everyone has 1,000, you could see if or you know what you could do is add the deductible back to the damage and then compare it or something. Or I mean, add it to the claim is what I meant, and then compare it to the damage. So like if you have $1,000 deductible and you had $50,000 of damage, your claim would be 49. So you could like add that deductible back onto the claim, and you should get the damage if you were getting paid the full amount minus the deductible. That'd be an interesting check and look at that.
Mhm.
It might be, do you know what the data, the sort of micro level data that you're gonna get is gonna look like? Because we might be able to suss through some things that you could do once you get it.
Yeah, unfortunately, it's more limited. I think it doesn't have, it just has claim amount, and it just has it doesn't have like deductible, as far as I understand.
Is claim amount what the person is asking for?
The amount is what they got paid. So it's just the end result of that whole process. I think it has coverage limit and amount paid. So you can kind of at least balance it off of that.
Do you observe like the property value or the like
Yeah.
like personal characteristics?
Yeah, I think so. I can share a little bit more about the property level validation. So unfortunately, we don't have access to the property data in-house. We our EDF intern from this summer, Helena, is a PhD student, and her lab has this property level data. The plan is to both use, there's like easily joined to CoreLogic property data, but also HMDA data. So her plan is to basically get some basic indicators of property value and race from mortgage and the property tax parcel data, and then test on those indicators that she can get at the property level, how much that matches up with the best correlate to the census geography. That doesn't cover everything. Like, we don't have education level at the property level or things like that. So it's not going to be a perfect thing, but we're hoping that it'll be at least a picture or a litmus test for whether or not it's like totally off or kind of aligned directionally.
One suggestion and one question. You might want to think about using fixed effects for the events, because I think you're getting like a lot of like kind of funkiness in the data from like individual events, which I think that fixed effect might absorb. And then I'm wondering if you thought about how to move into like a more causal approach with this.
Yeah, so I have a few controls for and test out a few controls for events, which is that anything that has a catastrophe number is like indicated as a catastrophe claim. And then also I have a like frequency of claims measure, which kind of gets at that. But yeah, I think having fixed effects to even just look at whether or not it varies, like what the effect is by hurricane, named hurricanes or whatever, I think is like a really important step. Yeah, the causal stuff I have been thinking about. I'm really curious if actually folks have any initial like thoughts or directions for this. I've been thinking about this and talking about it with some colleagues on this mock project. And one idea that got floated was looking at kind of changes in a tract census, like census tracts geography, or sorry, demographics, and then seeing the tracts that have a big change, whether or not the claims treatment changes as well. And in digging through that, I think it's going to be really hard to do that for a few reasons. That it's a lot of interpolation to attribute historical census data to claims. Census tract boundaries change over time, and all of the NFIP claims are geocoded to 2010 geographies. So we've had to join it in a way that like inherently has some like spatial interpolation. And we've pulled from other sources that have done a lot of work around that to help us do that. But it means that I don't think that we have like really clear changes in things like income or race that we can like compare against within a tract. So that's like the pathway that I was kind of trying to investigate, and then figured it wasn't effective, but curious if folks have other approaches that they would think about given this like data structure.
I think that
Go ahead, Jesse.
I think that approach sounds appealing, but might be challenging in practice, because I think like you're needing to have like repeat census tracts that show up across time, right? But like you're getting all this noise from like the individual events, I think. And it seems like it'd be hard to like, I'm just thinking about like, you know, like you can maybe like do that in a place for like New Orleans, where there has been like multiple like repeat claims over time, or Houston, and there's been like a lot of probably change in the demographics of those tracts. But I don't know, it seems hard to control for like the effect of the individual events adequately.
Yeah.
I personally don't think that that's the causal, like, even if you could get it perfectly, because the reason demographics change in different censuses is unobservable, and like there's I would personally be pretty skeptical of any sort of causal attribution based off of those types of regressions, but that's my 2 cents.
Yeah, I think it's just difficult. Like I think where I landed on it was thus far I don't have a good mechanism for making a causal inference from this yet, but these patterns are being talked about kind of colloquially, and so understanding whether or not we're even seeing them in the data from just a pure correlation or association standpoint might help inform the discussions. And I don't know, maybe it's like a second order question or investigation to develop some sort of causal thing. I think it will require.
It's like, I feel like the perfect data would be like you have a hurricane and like there's 2 houses next to each other with the same assessed value, and one's owned by a white person and one's owned by a black person, and you can observe all of it. Then maybe you could get at it in like that sort of setting, but it's definitely a heavy lift.
I think using Helena's data, you might be able to do that with like a propensity score matching approach, maybe.
Yeah, and I think maybe, yeah, like I think to your point, like I think it requires property level data, and we have the sample in North Carolina, and whether or not we can, I think it opens up another question that we had, which is when you have a sample that is fortuitous because you have it, but is just not indicative of the national sample, is it still impactful to like look at it just within North Carolina? So yeah, I think you're right, Jesse, that I think we could go a little deeper on the property level relationships here.
Hey there, can you see me?
Yeah.
I have a question. Do you think there'd be useful information in the CVI work that Aurora and others have been developing to bring to the table for looking at some of these houses or sites or regions, localities?
I think
Maybe
it could be
one to
interesting.
contemplate.
No, yeah, maybe I'll think about it more. I'm curious, maybe to not to like totally evade the question, but if Jeremy and Aurora have,
Yeah, Jeremy's
like,
on it.
yeah,
Before we're jumped off.
if you had like an initial idea of the fit, then yeah, let's do it. Let's explore it. I'm into it. I think I was very focused on just like, are we seeing any patterns in the data set we have? But building the onion outward,
Yeah.
great.
Yeah, I don't know if it would be useful, but if it's like a quick and easy thing to do, I think taking the full CVI like track level data set, assuming like do you have addresses or coordinates of each claim, I'm assuming?
No, we just have census tracked.
You have tracked. Okay. I mean, that could still work, but basically you could just throw in like the 184 vulnerability indicators in the regression and see what comes out of it, you know, just to understand if there's a lot of peripheral stuff that I think would be completely irrelevant, but you know, you might find something, I don't know, related to like number of civic organizations. There's like some layers in there that could have like, you know, some sort of correlation and interesting things to dig into more. But I think yeah, it would purely be just to get a sense of like if there's a thread you need to pull a little more or not. I don't think it would tell you much more than that. And if you want to chat about that, I'm happy to, and happy to. I'll link the data set in the chat if you want that.
Cool, thanks. Well, it's 2:00. Okay.
Go ahead, Karina.
I was gonna just wrap it up. I don't know if someone else was gonna do that, but thank you all for joining and engaging, and for the feedback. It's super useful. Took a bunch of notes. And yeah, I appreciate it.
Thanks, Karina.
Yeah.
Great
Thank
job, Karina.